What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is August 5th of 2024. Well, folks, I hope you all are hanging in there wherever you are. I usually be wishing you all a great day, but today is a pretty wild day for Bitcoin, for crypto, for asset markets, for Forex markets. The whole game is getting shaken up here, guys. This is one of the bloodiest days we've seen in Bitcoin since back during the FTX collapse. It's one of the worst days we've seen in altcoins in a long period of time. And outside of that, we're seeing ripple effects across the board in the macro world. Now, I want to dive into the charts today. I want to dive into what's going on, try to break everything down, get a full 360-degree view of what's going on. But beyond that, I want to talk to you guys about how to approach this. If you're already exposed to assets right now, or if you're sitting in cash, right? I want to talk about both perspectives and really just try to kind of keep things calm. I know a lot of people are panicking and finicky. I want to try to step back with the big picture. So we got a lot of things to talk about in today's video. If you happen to enjoy it, consider dropping a like, grab a cup of coffee, and stick with me here. We got some important stuff to discuss. So what's going on here? I want to start particularly talking about what's going on with Bitcoin here. We're down about 9-10% give or take here, depending at the time of recording. We see other coins, or generally the kind of broader altcoin market. Just turn off the drums here so we can really focus on the candles. We can see we're down about 10.8%. We were down, I think, roughly speaking, around 13-14% this morning. So it has been a little bit of a rebound since then, trying to see if prices can sustain above that 200 week. And I gotta say, guys, again, just taking a step back here, right? We talked for a while that there'd be a good chance we retest this range here. And it looks very clearly like we've gotten that here today. We already got close to it back here in July. And again, I just want to come back to a very important principle that I'm going to talk about here. Now, we're going to talk about all the reasons why Bitcoin can be declining like this. Is someone getting liquidated? Is it the carry trade in Japan? Is it geopolitics? All this stuff we'll discuss. But at the end of the day, right, we can talk about the headlines and try to find reasons. That's what most people try to do with markets. I want you guys to come back here again to something we've talked about. We have tried to be as non-biased as we can on markets. I've kept up with the idea that Bitcoin could come up here to 90 or 100K, but a lot of the time, you probably heard me talking about being a pragmatic optimist. While I'm optimistic on the future, I set high standards when I'm making trades. And one of the biggest things we talk about here, I don't use too many indicators. I use the moving averages. Because if the market price cannot sustain above those moving averages over the shorter ones, the 21-day, which is really the critical one for momentum that I look for. If it's not staying above our shorter term, 4-hour time frame moving averages, right? That may be kind of bad, but it's not the end of the world. If it's not staying above the 21-day, that's not a good look. And if it's not able to sustain above the 200-day or 100-day, that is sending alarm bells. And when you consider that back here, for example, we get rebounds at those moving averages, right? We wouldn't even think about coming down to touch that 200-day. But as we get more and more comfortable in those moving averages and we get a weaker reaction where the next time we just go through the 200-day, we just fade right through it, that is not a good sign. When you take a look at other coins and we can't even get above the 200-day or 100-day moving averages before people start taking profits and distributing again at a lower high, that is all the signs you need. You don't need me to tell you this. You don't need me. You don't need bulls or perma bulls out there to tell you that it's just going to go up into the moon. You shouldn't be listening to people who tell you one way or the other without giving you some clear evidence that price is showing it here. And there's practically nothing better outside of having maybe an understanding of market structure and other couple key principles than leaning into those moving averages. Because if we can't get above the average of the last 200 days, what does that tell you versus how we were reacting with before when we were above it and we were bouncing strongly off of those moving averages, right? So again, it's a very critical point to understand about the sentiment of the market. And I think fundamentally here, we all get it. Crypto has right now, before we even talk about the reasons why this capitulation is going on, I think we know that the fundamentals are incredibly weak in crypto, especially in the altcoin space. A lot of copycats, weak narratives, not enough new participants coming into the market. It's nothing like 2017, not even close to 2021. We have nowhere near that kind of acceleration or velocity and liquidity. So I want to go ahead and emphasize that here before we dive into really the macro discussion and how we tie it all back to crypto. So just an important tidbit there. A lot of people focus on, again, the market collapsing. Why is it happening? Just to get people riled up. We want to talk about lessons learned here. If you're in positions, right, I would wait for a little bit of a rebound here off the 200 week, but cut your losses once it gets to a point of reason, right? The fact of the matter is that you want to make sure you're sustaining above that 21-day moving average. Like back here in February when we were starting to build a lot of altcoin positions, look at that beautiful support well above that 21-day. Nice clear uptrend already established beforehand. We didn't have to be in first. We were making great money. Some of the best gains were made in those last few weeks of the run-up. And we locked those profits in and got out right here on April 7th when there was consistent weakness at that 21-day before the first initial dump. But I want to go ahead and talk about the macro here, guys, because the VIX right now is at its highest level that we have seen roughly since back here in March of 2022. This is the kind of prior range where we would see volatile events. We have had historically low volatility here for the past couple of years here, early in 2023 and 2024, back to levels we had back here in 2018, 2019. But this has been by far the biggest spike in the VIX we've seen here. And a lot of people are wondering what's causing this increase in volatility. For those who don't know, the VIX is the volatility index, the Chicago Board Options Exchange volatility index for the S&P 500. It's essentially measuring implied volatility across the S&P 500 when it comes to call and put options. So people are starting to take more hedges in the market. They're starting to expect more uncertainty about the direction of price, i.e. most people are starting to bet the prices could be moving lower. Again, the question of whether or not that will continue, that's where we can really start to either find some discount opportunities to buy or we sit in our hands and wait until an established bottom forms. Just take a look here across the futures. NASDAQ is set to gap down. This is the futures, so the market isn't trading yet, but it's expected to gap down about 4% at current values. S&P 500 down 2.6%. We've got the Dow Jones down 1.6% and the Russell 2000 down around 4.2%. Not looking good across equities. So what's really going on here? What's causing this mass capitulation, not just in Bitcoin and altcoins, but also in equities? Well, there are a couple things that we need to talk about here. The first thing is what's known as the carry trade. So I've talked about the carry trade once or twice before. It's definitely something that it could have been a risk factor for a potential domino effect that sparks a recession. But the major thing that I want to do here today is talk about what the carry trade is so you understand its impact. And beyond that, how it could spark a sort of domino effect across markets fundamentally. So first off, the carry trade is based off the premise that you have a major separation in central bank monetary policy. You've got the United States, which is currently maintaining some of the highest interest rates on the global stage, especially in respect to its economy and the power of the dollar. And this has essentially made the dollar very strong. Now, the dollar's continued to generally set higher lows over the trajectory of the last decade, but overall, the dollar's been remaining relatively strong. And that's mainly due to the fact that the central bank of the United States, the Fed, has been increasing interest rates, tightening its balance sheet, and essentially contracting the expansion of credit, making dollars more scarce, thereby increasing the dollar's value against other currencies. Now, it's been generally increasing across a whole range of currencies, but the one that it's really been doing great against is this by the currency in which is maintained by a central bank that has been doing the complete opposite. Really since back here, that this whole window of time as the United States has started to raise interest rates through the Fed, the Central Bank of Japan, or the Bank of Japan, the BOJ, has essentially kept interest rates practically at 0%. Basically, remember back in 2021 or 2020 when, in the United States, interest rates were practically at rock bottom. You really didn't get much interest in your bank account, but hey, if you were putting money in the market, you were doing good, right? So Japan has been living in that for some time. They've been on this unfortunate trope of just trying to keep interest rates low in order to stimulate their economy. They've had aging demographics. They're in a really bad situation from an economic standpoint. But the main point I want to get to here is that you have this counter difference between monetary policies of these central banks. And this opens up a window for speculators to essentially make what they feel is free money. And to be fair, so long as the game plays and the music's going on, we're in a game of musical chairs here, it also works. Essentially, people were going out borrowing money from Japanese central banks at practically rock bottom rates, almost free money, also, so long as you return the principal one day in the future. Taking that money, exchanging the Japanese yen that they were borrowing from those banks into dollars and then going and buying various different types of assets. You could name all types of different things. You could buy real estate, you could buy stocks, you could buy more specifically the tech companies that have been doing really well, buying into the AI trade. You could be buying Bitcoin, you could buy altcoins, really whatever at the end of the day. Because at the end of the day, you've got to return that money or you're going to default, right? So essentially, what's been going on here is a lot of people have been doing much more likely than not. They've been taking that money and going and putting it in a U.S. bank account. This is essentially what's made the carry trade so popular. You can get 5%, roughly speaking, 4 or 5% in the United States and most commercial banks. You've got the dollar, which is appreciating against the Japanese yen, so you're winning out in the Forex pair. But beyond that, you're also making a 5% yield guaranteed pretty much so long as those interest rates kept up in the United States and so long as the Japanese central bank, the Bank of Japan, kept interest rates low. Well, there's a problem now. The Bank of Japan just started increasing its interest rate, signaling that it may be shifting that direction. And this was enough. A 25 basis point increase, practically nothing, was enough to spook enough participants in the carry trade to start rotating, getting their money out, taking their dollars, right, selling the assets that they own, getting back the dollars, taking it over back to Forex markets, converting to the Japanese yen, and then essentially paying down their principal. And some people probably made a killing, got out in time, and made some free money scot-free, and they're all good. However, though, there are a lot of people who, for the past, really the last 6-7 months, were participating in this carry trade, and they've just gotten caught with their pants down. So now they're becoming forced sellers here, right, to cover themselves. I think at the end of the day here, we're going to find that someone blew up here. This is going to be potentially an event that could cause some contagion. We're going to have to see. But at the end of the day, that's what's likely played out here. That is likely why we've seen such a dramatic drop here that has essentially ended the carry trade for so many participants here and really has brought the Japanese yen back here to where it was in June of 2023, right? So if that really starts to break down even further, this is just going to cause more pain and capitulation. People are going to have to cover, they're going to have to sell in other places to cover for their losses or to essentially cover for the difference. So this is a very important dynamic to understand. And this does relate to crypto. I know some people are probably wondering, Nick, what does this really have to do with Bitcoin? Was the carry trade really, part of crypto as well? Yeah, I think there most certainly was. I don't think people who were this dumb to take so much risk, who going out there and borrowing what felt like free money, I have no doubt that there were some large whales or participants in crypto. I've been wondering for a long time, for the past couple months back when there was the ETF flows. I understand the ETF was a bullish event for crypto, but I was wondering, where is this money coming from? Like, who's propping this up? Because I don't see, a lot of people, a lot of boomers going out there and buying Bitcoin. I don't see a lot of Gen Z going out and buying Bitcoin right now. I don't see the euphoria and the easy money back that we had in 2021. And jump trading, which is one of the largest market makers in the industry, has essentially seen on-chain as just unloading heaps of positions in the market. And this to me makes me think that, we saw this back on the weekend. This is essentially for selling. Someone's covering or someone's looking to get out ASAP because they essentially have fallen short somewhere else. So anyways, at the end of the day, guys, we don't know all the details around this. No one does. But there are a ton of red flags beyond this. There are a ton of signals that have been talked about for a long time. We've tried to cover here on this channel. The yield curve uninverting, we're back near that 0% target we've talked about. When that happens, it's time to batten down the hatches and get ready for some pain. To expect that a lot of the big tech companies, a lot of things that have won out, Bitcoin as well, are probably not going to fare as well as people think in a recession. It's just simply not. You can take a look here. We've got another signal, like crude oil futures here. I want to turn off everything here except the indicators, just turn off the drawings. And I want you to focus, it might be a bit difficult here with the moving averages, but see this orange, this reddish orange line and the normal orange line? That's the 200-week moving average. We have yet to have a weekly close below there throughout the entire period where it was starting to test this range in 2023 and 2024. We have now got really, I think, effectively the first real weekly close here in late July of 2024. If Oil's declining here. That means inflation's cooling down. The Fed has done its job. It's basically brought us back to supply and demand equilibrium. And along with that, it's likely a sign that demand is shifting much lower, not supply increasing. So this means that we've got recessionary pressures playing out in oil prices. Along with that as well, you've also just got the important point here to consider, guys. Equities have been overvalued for a long time. I mean, take a look here at Apple, right? Apple, current valuation, $3.3 trillion. $3.3 trillion trading at a PE multiple, even after pulling back here over the last few weeks, at a PE multiple of 33. Absolutely insane. And all off the back of essentially Apple Intelligence, their really weak AI play, in my opinion, out of all the things I've seen. You can take a look here. Microsoft, $3 trillion market cap, even after a pretty solid fade here, was at a $3.3 trillion market cap. Huge, huge valuation here for Microsoft. Nvidia, still trading at a PE multiple of 63. It's got to keep that earnings acceleration going. If it doesn't, if it has a weak quarter, there are going to be a lot of people caught with their pants down. $2.6 trillion, even after the pullback here, right? We've had a 40%, not 40% pullback, but more around 30% pullback, roughly, taking here into account the recent highs of 140. Down at the 100-day, barely getting any buyers coming in. Last time, we didn't even come down to touch the 100-day. Last time we tapped it, right, we were able to get back above that 21-day. The fun continues. In this case, the 21-day was resistance time and time again, and we are barely hanging by a thread on the 100-day. This is probably going to gap down, I would assume somewhere, down here towards 95, probably sometime in the morning, I don't know. The main thing here is that if you take these three companies, you're still looking at roughly $9 trillion in market cap between three technology companies, a huge amount of equity concentration. And if you expand that to the Magnificent Seven, if you include, for example, the FANG stocks, which, mind you, are trading at a higher valuation than where they were back in the peak of 2021. And again, I come to you and I ask you, do you think these companies are somehow more resilient, set up from the same level of growth expectations that they had in the peak of 2021 now that we understand where these companies stand? Is AI really going to be that savior? Well, we certainly don't see that in the semiconductor stocks. We don't see that in the trend in NVIDIA. I think a lot of people are starting to realize that this has been full of a lot of empty promises. People have been oversold on the capabilities of AI here in the short term. And while it might still be an optimistic future for AI and robotics, I'm not bearish on it per se long term. I do believe in the short term, we've been essentially sold on an essentially overbought narrative at this point. There's no way to put it. And I just simply need to take a look at the pre-planned stock selling program that Jensen Huang has taken out. Again, hey, no beef to Jensen. At the end of the day, it's all out there. It's public records. Market participants should have been looking at it. And he basically started this program at the time that signaled the top in NVIDIA. He started at 131. That is not far off here. It's pretty much near the exact top here in NVIDIA. It's all public record, guys. And I'm not saying every insider transaction is evil, nor am I here to say that it means that you absolutely have to short the stock. But it's one of many signs, if you look across the board, it's just clear and present. Not to mention, we've obviously got the tensions in the Middle East. I don't want to completely change the subject here, but we've talked a lot about tech already and just the bloated valuations that we're bound to eventually correct to some fashion, right? We've got obvious tensions going on in the Middle East. The United States military sending resources aiming to de-escalate. No one knows if that's going to work. This was following the killing of the Hamas chief in Iran. So we've got a lot of geopolitical uncertainty as well. But I really come back here again to the big picture, right? People say, oh, it's Middle East tensions. People say it's a carry trade. It's just a general correction of markets, a black swan event. Everyone likes to label things. Guys, look, at the end of the day, I'm kind of sitting here wondering, where are we in the grand scheme of things? I'm a macro trader. I think I'm much like a lot of you guys out there who are just not wanting to day trade, not wanting to just passively long-term invest. You want to be able to capture big opportunities over a 1 to 3 year long period. That's why a lot of you are probably attracted, like myself, to crypto, like that you can trade these big cycles and make life-changing returns. And you're probably wondering, are we bound for that here in the next 6 months anywhere in the market, or are we likely heading lower? And that's a bit difficult to answer, But I come here to this really interesting chart, and I want you guys to just consider the possibilities. This was a chart we shared within the Dash report. It's our newsletter here in the channel. This is something we've warned about a lot within the dashboard. We've also talked a little bit here on the channel. I don't want to gatekeep all my information, right? And I don't get everything right. But I have to say, one habit that I built that I think a lot of people struggle with is zooming out. I love understanding the story of markets. I love understanding where we stand in the grand scheme of things. Are we completely blindsided that we are extensively overbought, that we are in a euphoric period of time of irrationality, of just constant optimistic thinking that could be eventually badly burnt when things start to change? Or are we at historic discounts that could be the cusp of a bigger move where we can make life-changing returns? And look, at the end of the day, there's a lot of nuance in answering that question. There could be opportunities even during general downward moments. But when I take a look here at the S&P 500 and I look at the 100-year chart here, we are talking about a channel that has remained consistent since back here at the peak in 1929, the Roaring 20s you probably studied about in your historic textbooks of the United States if you were in the US, or maybe you learned about it abroad. 1929, we're talking about almost 100 years of price action that has fit into this channel here. And we are yet again similar to back in 2021. Not that far off from that high. Now, is there a chance that we dip to the 200-day, or maybe we bounce some time here soon and we come back here and test this range? Sure. Is there a chance that this channel could be broken one day? We could have a melt up due to massive currency devaluation. Maybe the Fed's response here to this situation, which could really get out of hand, becomes extensive and they start printing more money again. They feel that inflation is set to actually turn into deflation. It's time to turn on the printer and juice up the markets. Maybe that happens, right? Maybe we need to do that to essentially pay off our fiscal deficits, whatever. Essentially, at the end of the day, I'm going to be keeping in mind that this channel has been holding for a very long time. And there are periods of time throughout history. Sometimes, again, I'm not going to just use these two data points as an absolute certainty. I'm just here to, again, let you guys know what I'm watching, and it's something to consider. And that is that there are periods of time where we move from the extreme high to the extreme low. Now, what I see over history is a moderation, essentially going from the exacerbated fast rally here from around 8 on the S&P 500 here to 33 within a very short window of time, down here towards 5 on the index. I see a much more moderate expansion here over a longer period of time, again due to innovations in technology and increased productivity, and a decade of general stagnation going into 2009. And then after that, another expansionary wave. My point here today is that, broadly speaking, unless we are going to see the companies, the big technology companies, or the broader equity market for that matter, continue to expand their earnings, if we are going to continue to see those things, then we can continue to maintain in this upper band. But I don't know if we can really expand much higher. The much more likely scenario that could play out, it's going to become ever growingly likely here over the next couple of weeks and months, if there is more capitulation in the market and there is continued lack of expectation of growth, then you could see something like this play out where we get essentially a lost decade, where it takes a long time to return to these valuations. And I'm not saying here that I want to take back a little bit of what I said earlier, just to clarify. I'm not saying that that's has to be the likely scenario. What I'm here to say, though, is that it is a possibility. So just be prepared for that. Don't get caught in the idea that everything is just going to be happy, pappy, la la land. We're always going up and to the right. Hodl, 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 Bitcoin. That could really leave you trapped. And I've emphasized this again. I want to bring it back here to crypto a little bit. There are some clear warning signs here, guys, that Bitcoin is struggling. We have not been able to break away. Even with the ETF, we have not been able to break away from the same resistance and distribution range from back in 2021. Think about that for a minute. I know a lot of people thought I was being, overly bearish here, but just look, the fact that we're actually more than $20,000 lower from the all-time highs. And that high range, right, we haven't been able to test it since. We've had slightly lower highs each and every time. And the sell-offs are getting more dramatic. You can just see it here in the price. The moving averages are not providing that level of support. And the next major moving average we have is the 200 week down here at 38,000. I'm not saying that we got to go down there, but the last time we couldn't hold in those moving averages, we did. And we have seen back in the past that Bitcoin can go through some pretty extensive corrections. And I think this again just gets more back to the fundamental question. Will Bitcoin really be able to even go to new all-time highs? Will it be able to go to 100K here in the next year or so? You have plan B and so many optimists saying that Bitcoin's going to $500,000, which I think is just reckless to say at this point. Then again, it's using a regressive model, which adapts to essentially factor in new price action, and the model will readjust its target over time. That's how regressive models work. So that's why they're not perfect and not something you should totally go off of. But anyways, I'm not here to just bash them. There's a lot of perma bull activity out there. And I'm not here to be a perma bear. I'm just here to say I set my standards and the moving averages are not looking good. At least back here, we were able to hold on that 200-day relatively well. And when we dipped below, we went sideways and moved quickly and swiftly back above it. This, to me, looks like real inconsistency in the trend. And it tells me at this price range, people are not so willing to go in here. There's much more market sell-side pressure than there is buy-side pressure. And while there's always a buyer and a seller for each side of the trade, it is the market order flow that will lead the direction of price. And it is why it is so imperative to watch those moving averages and listen to what price is telling you, to listen to cumulative volume delta, the essential difference in that market order flow that is going to drive the direction. And again, going back here to the S&P 500, we're paying pretty high multiples here for the S&P 500. If we cool down those multiples, right? If you see, for example, a 30-40% contraction of those P multiples, the companies which are making earnings today could not even have a dent in their earnings, but their valuations could drop extensively. This is what happens during recessions, right? When earnings get, essentially earnings projections get written down, it starts causing a spook in the markets. Not only are they probably right, the earnings are going lower, which means that the companies are fundamentally worth less than they were before. But beyond that, people stop paying the same kind of growth premium when they start seeing that these companies are stagnating. I look across the board and I see these signs here, guys. I see the ETF inflows not doing very well here. Really considering here that really over the last 2 months, we've only seen about an expansion of 54,000 Bitcoin into the ETFs, globally speaking, right? And while that might sound nice, it is an uptick in the amount of Bitcoin being stored in these ETF products. We just had the German government selling off 50,000. You've got Mt. Gox distributions paying out now. You've got, one of the few things that might have really gotten us hopeful was the United States holding its massive Bitcoin position of over 203,000 Bitcoin. This is something that really wasn't even on the table as a discussion point of sell-side pressure back a few months ago. Now it is something we got to consider for the long-term reduction of price, especially now that we just saw 10,000 Bitcoin being sold off the other day. And the political administration potentially using that as a weaponized tactic against the Trump administration that might come back into power, right? At the end of the day, right, there's a lot of Bitcoin sitting out there, and I'm not sensing there's a lot of buyers right now. And that leads us in a position where we can have price discovery. So above all, guys, we talked a good amount here today about what might have been causing this. We talked about some important things around the moving averages, but I want to close off here by talking about the thing that matters most. And that is the question that is on so many people's minds, and that's whether or not is this the bottom or are we moving lower? That question is incredibly hard to decipher here. And I want to make it very clear that that's not the objective. The objective at the end of the day is to not catch falling knives, because in many cases a falling knife, once it stops falling, it's not going to just sharply rebound higher and just continue uptrending into the sky. There will be many retests. Other coin dominance is a great example of this. We timed that near-term bottom perfectly, a retest of the 200 week, but it looks like we weren't even being bearish enough because it's moved even lower since. And if you follow that simple strategy of leaning into the moving averages, you can buy into capitulation at those kind of key points. But what you've got to do is make sure that you set stop losses at reasonable ranges to mitigate your risk, and be open to taking profits when you see clear warning signs like not being able to get above the 200-week moving average or the 100-week moving averages, those long-term ones, if they happen to be the resistance point you have to worry about. In this case, for Bitcoin, it was just an inability to really sustain above that 21-day for a meaningful window of time, and to have that 21-day making new highs. Right? We want to see not only price setting a new highs, we want to see this moving averages ticking higher, because it's showing that there's an average higher price that people are willing to pay. It's a story that price is telling you. And that's again why I think that they can be so powerful if you really listen to them and don't focus so much on getting the absolute lows or the absolute top. We are going to continue to track this, guys. I know Russ will be doing some videos on Wednesday and Friday. I definitely recommend, if you guys haven't been watching him, Russ has been to a T nailing some really great trades in silver and in the commodity space, but he's also been making great trades in crypto. He's been making great trades as well when it comes to the focus on technology stocks and semiconductors. He rode the wave up on NVIDIA, called the top, shorted it down, and also as well as looking for some potential long entries as well. He's been really good on a lot of different plays here in the market. So I recommend you guys check him out. Go give him a watch and see whether or not you enjoy his content as well. But I'm going to be back here again on Monday, giving you guys some updates on where things are going. Right now, we've got one sizable equity position that we're talking about in the Dash report. If you guys want to know what company we're long, definitely consider. We actually got two technically in that sector. But otherwise, we're mainly in cash in this case, other than those positions. So we're not holding any like significant major crypto positions at the moment. We are just waiting to see whether or not we are getting that opportunity to finally go long the sector, because right now this just doesn't look optimistic. This looks like this has got a long way to go and a big flush down from the prior kind of contestment range that we had back here in December of 2023 to February. We might really come down and retest that range and give up a lot of those gains from the ETF, getting through this wave of sell side pressure. And then from there, we got to see whether or not we can really move higher. That is a possibility. It's not guaranteed, but it's a possibility we got to consider here. And especially if we can't get above some of these prior lows, this will be your kind of giveaway here. If we get a rebound in the next, couple days, and you can't sustain, back above the 200-day, let alone if you start getting shot down at some of these prior lows back here in July, that's your signal to run for the hills. So, anyways, guys, important thing to keep in mind here: preserving and protecting your capital matters most. Is the biggest reason we haven't been crazy in altcoins since back in April. And boy, have we avoided a lot of pain from doing that. I wish you guys all the best, no matter how your position. If you're in cash, start looking potentially for those opportunities where price might be signaling strength to you, but set your stance high. Maintain your conviction. If you're in positions that you need to get out of, guys, or you're feeling like you're down in your positions, at the end of the day, learn from those losses and mitigate them when you can. When you get those rebounds, right, similar to the ones we talked about here, those long-term moving averages, and price is not budging, it's not getting through, you gotta get off the high horse, stop focusing on trying to make money, and make sure you preserve and protect your capital first and foremost. That's what I highly recommend to you guys. A lot of people won't tell you that because they make money from you being a perma bull or always being optimistic on markets and not thinking that for once it may go down. I hope you guys have a fantastic week wherever you are. We'll be here during good times and bad as always. If you enjoyed my rambling, consider dropping a like. It's a great way to support the channel. And if you like the content we discussed here, you may very well like the Dash Report, our newsletter. I won't sell it on you guys too much. We got a lot of great stuff in there. Huge amount of our community, some of the best traders and participants in the DataDash community. A lot of great conversations going on during this crazy time that can help to give some perspective beyond just me. But we're also going to be having our mid-month webinar where you guys can ask me questions coming up here in the middle part of the month. And we just dropped a fresh Dash Report newsletter that I think you guys will like. So hope you guys have a fantastic day wherever you are, and I'll see you all in the next video. Take care, everyone.